Great. Thank you. Thanks everyone for joining. Um, Good afternoon, everyone. So let's get us started with our topic for today, which is advanced fundamental analysis. Good afternoon, everyone. So before we get started, let me introduce myself for you. My name is Ahmed Yousre. I am working as a global macro strategist at P Prime. I'm also a Forex trainer as well. So before jumping to the Forex, I have been in the banking industry. I worked as a RM relationship manager in one of the biggest banks in Egypt and Africa. And then I jumped to coaching and then finally the CFDs industry and Forex trading. Okay. So before we get started, do you guys aware of the fundamental analysis as basic level or just let me know what level have you reached in the fundamental part? Because it's important, because if you are in the beginner level still, then I should give like some basic level at the beginning, and then we advance to the level that we need to discuss today. So can you please write in the chat what is your level for in the fundamental part? Beginner, I am more beginner, beginner, okay. I'm more the basic level. This is my first webinar. Okay, that's good. Good. Beginner. Brilliant. Okay, so yeah. So that's good. So usually, okay. Okay. So most of us, we are still having, the first webinar. Some people here joined for the first time. Most of you are beginners. So the topic is usually that we're going to discuss is the advanced financial or fundamental analysis. However, it's all linked together. So I cannot go deeply into the advanced level without teaching you the basic level of the fundamental analysis part. Now, let's get started and I'll let you know what are the topics that we are supposed to cover today. So today we are going to cover the definition of the fundamental analysis. Okay. Number two, we are going to figure out what are the key economic indicators, which is the main thing that we should look at when we are fundamentally analyzing the currencies or gold or whatsoever. And then we will discuss a very important thing, which is the correlation among different asset classes. And then we will end the session by giving 10 minutes for your questions, and definitely I will answer all of your questions. Okay? Is it possible? Yeah, of course. Okay? Of course you can. Now, so let's jump to the first part, which is the fundamental analysis. Now, I'm not going to go through the slides since we are a bit, um, beginner. So I just skip this part for now. Let me just do my notes. Okay. And then we are going to jump to the notes. Okay. So guys, it's very important to understand that we do have two type of analysis, right? So the first part or the first type of analysis is that usually everyone knows about it here as a traders. So we do have the technical analysis and we have the fundamental analysis. So fundamental analysis, it's not only in the Forex trading. Fundamental analysis can go deeper in the company analysis. So the word fundamental analysis is that I'm not looking anymore to the charts. So we as traders, we usually see the charts, study the candlesticks, study support and resistance, all of these things that we hear about it on the YouTube, on the social media, or whatsoever, right? This is the technical analysis part. So here we just care about the candlesticks, we care about the supports and resistance, all of these stuffs, right? But the fundamental, okay, it goes beyond the price. So if there is an up movement in the market, okay, this up movement, it might be because of a fundamental part. So what might take the price higher or lower, this is what we call it fundamental. Okay, so the fundamental analysis, it's very important. Okay, as a traders, you cannot skip the fundamental part. Okay, because the movement in the market, whether the market is moving up, the market is moving down, the market is ranging, this is all because of the fundamentals. Okay, so the fundamentals usually in Forex, it might be news, it might be geopolitical tension. Okay, it might be some other reasons for the companies, it might be their financial statements. Okay, it might be some wars. So these are known as fundamentals. So anything that is apart from the price and the candles and the trends and all of these things, it is called as a fundamental. The main driver for the market to move are the fundamentals. Okay, so now, since we understood what are the mean of the word of the fundamentals, it's very important to understand what is the effect of every item of these on the price. Okay, so usually every single minute, we have some news happening in the market. We have some tweets by Trump. We have some breaking news, geopolitical tension. Trump, some people that are saying kidnap Venezuela president out of her home and so on. These are all things that lead the price of asset classes to move. Okay, so if you analyzed these fundamental parts well, you would be able, it would give you some edge to forecast the next movement in the market. Okay. However, guys, let's be honest. Sometimes the market does not respond as we wish. Sometimes we analyze the fundamental correctly, but the market goes into the opposite direction. Okay, so it's not a formula. It's not a formula. Like, it doesn't mean that if I told you if interest rate goes up, the currency should go down. This is not a rule. Okay, fundamentally, we are going to explain it. However, the market might respond in a different way. Just take care of this. Okay, now. For now, everything is clear, like as a basic introduction about the fundamentals. All good? I need thumbs up. Okay. So I guess for the recording, it will be published on the website, right? Okay, that's cool. Okay, good. Now, what is fundamental analysis? It's the process of evaluating the underlying economic, financials, and geopolitical factors. Now, the most important three things, okay, since we are traders, okay, number one, the key economic indicators. And believe me, if you got the key economic indicators, 100% you are fully aware of the fundamentals. This is the most important thing, okay? Geopolitical factors, it's also important. And the last thing, it's corporate financials. So for the corporate financials, here we speak about people who are interested in trading stocks. Okay, so if you are interested in trading stocks and long-term investment, okay, this is part of the fundamental analysis. Okay, I'm not gonna go deep into corporate financials. However, I'm going to focus on the first two things, the key economic indicators and the geopolitical factors. Okay, good. Now, let's discuss the key economic indicators. Now, guys, this session is going to be a bit, technical in terms of economics. Okay, so if you're not aware of what is economy or what is macroeconomics, doesn't matter because I'm going to give you the bigger picture where you can understand and link all these economic indicators together, right? So let's think about it. Now, let's assume, okay, we have country X. Okay, I'm not speaking about a specific country. I'm just speaking about country X. So this is a country where people live, right? So this country, guys, it has some resources. The most important thing is to understand what are the resources. So guys, resources, it is everything that is owned by this country. Land is considered to be resources. People are considered to be resources. Water are considered to be resources. Okay, good. Now, this country would use these resources in order to produce goods and services. And this is how the economy works. So guys, if you think about the economy as a bigger picture, okay, we would find that the economy is composed of two main key players. People who consumes, and those are called consumers, right? And we have some firms, okay? And those firms are producers, right? So we have consumers and we have what? Producers, right? What happens in the economy? How the economy actually works. So the economy works in a very simple idea. This person, okay, he's considered to be resources, okay? So this is known as labor. Employee, someone who's educated, he has a certain skills or whatsoever. Now, this person is going to be hired by the companies, by the producers, right? Now, in the very basic question, why, guys, do we work? What is the main idea? Why do we work? Can you answer me? Why everyone is looking for pay bills, making money? Okay, we just need some money to survive, right? To pay our needs, to pay taxes, to pay our bills and to support our families. We just need money, right? So this money to earn a living, 100%, right? This money is going to be paid by the producer. So this guy is going to be employed here in this company. Okay, so he is employed. Now he is described as an employee. Good. Now this person, okay, has been hired. Now we are expecting if you worked for a full month, now the company is going to pay for you some money. Good, good. Now the question, why do companies hire people? Same thing. Why do companies hire people? Hmm. Another question, very simple question. Why do companies hire employees or hire peoples with skills? For the services, good. For the goods, to operate their business efficiently, 100%, because they cannot do the work alone, 100%, to increase their income, to produce, and that's perfect. So this company would like to produce goods and services. Now, who is going to support this company to produce the goods and services? This person, the employee. So this guy has actually taken the money. He has helped the company to produce the goods and services. Now, he got the money. What he's going to do? He's going to spend this money on the goods and the services, right? So once he spent this money on goods and services, this is going to be a profit for the company. And if the company is doing so well, the company is going to, reinvest its profit and maybe open another branch or expand or another business project and so on. And then the circle is going to continue like this, right? That's good. Now, in the middle of all of that, the government is just watching here. Okay, so here we have the government. This guy, once he work, he has to pay taxes. And this company, once it makes profit, it has to pay taxes for the government. Now, the government takes this money in order to maybe do some services or give some subsidies for the peoples or some, support for people who are unemployed, making projects, healthcare, infrastructure, and all of these things. Okay? Now, this is how simply the economy works. So, if I come to the first economic indicator, okay? Okay, yeah. If I come to the first economic indicator, which is the GDP. So what is the GDP? GDP, guys, it's very simple idea. It refers to the gross domestic product, okay? And the gross domestic product simply means, okay, how much goods and services we as a whole country have produced in a given time, okay? So the GDP refers to how much, okay, goods and services we have produced in a given year, right? Good. Now, this GDP shows what? Now, if I told you we have two countries, right? We have country A and we have country B. Country A has produced goods and services that is worth in the dollar value $1 million. And country B has produced goods and services which has a total dollar value, for example, let's say $100,000. Now, tell me, which country is better from your opinion based on what you have understood? That the GDP is the production. What do you think? Of course, of course, country, right? Because country A has produced more, right? So producing more, this means that there is more demand, right? So if you are producing more, it means that we are supplying more. Supplying more means there's a lot of demand and people would like to consume more, right? Good. So if I just looked at the country, if I just looked at the country GDP, now, do you think which country has a better or stronger currency, A or B? Of course, A, right? That's very simple. Okay, because simply we have a country with a huge production, huge labor, and they are producing a lot. Okay, so this means that the economy is doing well. If the economy is doing well, then it should be the currency as well doing well, right? This is a very basic thing. Okay, number two. Now, if the GDP, guys, if the GDP is going higher, we are producing more. Now, how can we produce more? Remember, if this country that we just spoke about it, if this country would like to produce more, okay, this guy cannot produce everything. So they would hire what? They would hire more people. Okay, more people to be hired, more goods and services to be produced. Okay, more goods and services to be produced, it means that there are more people to buy. More people to buy means more what? More profit. Okay, it's a cycle, just a simple cycle, right? So definitely there is an important relationship that you should understand here, that the GDP cannot, okay, go higher. GDP cannot go higher without the unemployment goes down. Okay, GDP cannot go higher without the unemployment goes down. Okay, because if you want to produce more, you need to hire more labor. You need to hire what? You need to hire more labor. Okay, let me check your questions, but the currency is in USD for both. Okay, no, just forget about the USD right now. Okay, okay, because we are going to speak about the USD and different currencies right now. I'm just giving just a simple example. Okay, okay. Now, so the GDP is high, the unemployment should be low. Now, here's the question, guys. What's gonna happen to the inflation? So, very important thing to understand here. Inflation is also linked with the GDP and employment because we produced more. Now we have hired more people. So the sequence is, okay, let me just draw it here. These people, we have three persons, okay? They were unemployed. Unemployed. They are not working. So what is their income? Their income is zero. They don't have money. Now, when the company decided to increase their production, when the company decided to increase the production of goods and services, they decided to post on LinkedIn and they decided to hire more people to work. Those people, luckily, they applied and they got a job. Once these people will get a job, what they will get? They will get salary, right? If they got a salary, it means that they got what? Income. So if I got income, it means that I will spend more or I will spend less. If someone has no money and out of a sudden he got a job and he now become having like a lot of money or a salary or whatsoever, he would spend this money, right? Yes or wrong? He would spend this money, right? Of course he would spend this money. So when he spends this money, this means that the demand on goods and services is going to increase. Demanding, 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 demanding. And let's look again to the example that we just spoke about it here. Okay, this one. Okay, so if people are buying a lot of goods and services, people are buying a lot of goods and services because they have a lot of money. Okay, they have a lot of money, let's buy. Okay, so the company would say, oh my God, people are asking a lot for our products. Okay, they like our products and they are asking for a lot of things. We need to produce more, right? So this demand is going to let this company to hire more people. And if it hire more people, okay, the cost on this company is going to increase. Now, I was just paying $1,000 for one labor, one employee. Now, because people having money, okay, I need to hire five people. So what's the cost? The cost is 5,000. If the cost is 5,000, then how can I make profit? Okay, I need to increase my prices. So instead of selling the item for $100, I'm gonna sell it for 120. I'm gonna sell it for 130 to make profit because simply my cost has increased, right? So if the cost has increased, okay, and people has a lot of money because of high demand, this is going to lead to a high inflation. So the high inflation is what? High inflation, actually, it is the reason because of money. If people have money, okay, and they are demanding more, so demand is going to lead the prices to go higher and higher and higher. Okay, so simply, there is three key economic indicators, and there is a clear relationship between these three economic indicators. Number one, if the GDP is going higher and the economy is doing well, so we need to increase this production by hiring more people. So the unemployment is going to go down. And then if the unemployment goes down, this means that people are getting more money, more income, which means that the inflation is going to go higher. Okay? This is the very basic relationship. But the production will increase also with additional manpower. Of course, the production is going to increase. But this is, in economics, we have something called the diminishing marginal returns. So as long as you are recruiting people and you are paying for them at a point of time, your cost is going to increase more. Okay, and if your cost going to increase more than your revenues, this means that you are going to have some losses, right? And then there is a turning point happening. I don't want to go through technical economic part, but this is how it works. Okay, so we just need as a traders to understand the relationship between the GDP, the unemployment, and the inflation. Now, inflation, some people now we are hearing a lot about inflation, right? And a lot of guys saying that inflation is something bad. Now, the question is, Is inflation really something bad? What do you think? No. Christina said no. No. Yes, for low-income households. Good. No, not always. Okay. So, guys, let me tell you one thing. Inflation is not something bad, is not something bad if the cycle is just as I have explained for you. Higher GDP, more employment, more income, high inflation. But if the inflation goes above a certain level and it started to increase more and more and more, and this cycle it's not changing, now we can explain that the inflation is something bad. Okay, so let me just give you one simple example. Okay, so and this example actually in a lot of countries right now happening. So the cycle might not go smoothly as you think, right? So in some countries, what happens is GDP is going down. Okay, unemployment is going up. Now, let me ask you the question here. What do you think should happen to the inflation if the GDP is going down and the unemployment is high? To the normal cycle, what should happen? Excellent. The inflation should simply go down, right? This is the normal cycle. Now, the other cycle is what? Is that GDP is going down, unemployment is going higher, okay, and the inflation is going higher. This is happening in a lot of countries. Turkey, Lebanon, Egypt. This is known, guys, as stagflation. This is known as what? Stagflation. So what is the stagflation? Stagflation happens when the GDP or the country it has no economic growth. It has no economic growth. However, the inflation or the prices are going up. And this is why, Christine, this is because of external factors. So for example, let me just give you a quick example so we don't waste our time in this thing. Okay? The example is let's assume a life example from Egypt. Now, Egypt, okay, it has exports and imports, right? Any country, it exports some of their goods and services, and it get from other countries some goods and services. Okay? Now, 90% of Egypt basic needs like medicine, food, clothes, okay? It is imported from other countries. Okay, good. Now, if you are importing 90% of your basic needs, such as medicine, such as food, such as clothes, all of these things, you are getting these from, for example, let's say China. Now the question, would Egypt pay for China in the Chinese currency or it's going to pay in dollars? What do you think? So the international trade, guys, always happen in dollars, 100%. So Egypt needs to pay for China in dollars. Good, that's good. Now, let's go and check what happens to the dollars against the Egyptian pound. Let's see. Okay. And now you would understand how the stagflation might happen, right? So if I just go here And I'm gonna not open a chart. I'm just gonna write USD, yes, EGP, right? So, or let me do the vice versa to make it EGP USD. Sorry. Okay. So let's guys see. Okay. If I just bring the 5 years. Okay. So 5 years back, okay, in 2021, $1 was equal how much in Egyptian pounds? 15 Egyptian pounds, right? In 2024, $1 equals how much Egyptian pounds? 30. So in 2021, okay, now let's just understand this example. Now, there is one guy here who is a consumer. He was buying this box, okay, at $1, okay, which is 15 Egyptian pound, which is 15 Egyptian pound. This is in 2021. Now, the same box in 2023 for the $1 that we have imported from China, it is going to be sold in the Egyptian market at how much? At 30 Egyptian pounds. The prices has doubled 100%. Okay. Now, if you jump more to 2025, see, it becomes 50. So the $1 now is not becomes 30. So this box is going to be 50. Now, this guy, actually, his country is not producing too much. They don't have more opportunities. There is no economic growth. But the prices are massively going high, almost like more than 200% increase in the prices, the same dollar, because you are importing basic things from external parties and you are paying in dollars, but the dollars against your country is actually appreciating, right? So this might be a cause, external factor of what? Of inflation. And this is known as stagflation. Okay. Same thing happens in Lebanon, same thing is going to happen in Turkey, and so on. Okay. So guys, it does not necessarily that the market actually follow the cycle. Maybe there are some external factors that might lead to the inflation apart from people having a lot of money, right? Is that clear? All good. Crystal clear. Good. Now, I just faced here some questions. So, I think Nina mentioned how about AI impacting unemployment while GDP growing? Actually, AI is not going to affect negatively the unemployment. See, there is something in economics called the structural unemployment. Okay, Nina? So what is the structural unemployment? This is an unemployment due to lack of skills. So if you just figure it out, in the past, people were not able to use computers. Okay. A lot of people, they have left their jobs because they don't want to learn the skills of how to use the computers, Excel, Word, and so on. So they have left, right? And then after that, okay, Q&A. Do we going to have regard this meeting? I might want to revisit again. Yes, of course. Yes. Okay. So, and then now in 2025, the AI is booming. Okay. So if you are not able to use the AI, of course, the structural unemployment, it's gonna happen. Okay, but structural unemployment, it's not bad as long as people have the willing to learn. Okay, anyone would learn the AI, how to use the AI. But believe me, AI is not going to replace and make everyone unemployed. This is not gonna happen. Okay, and if it's gonna happen, okay, this is gonna take a lot of time. But at least if we are going to have anything that is run by the AI. Okay, so who is going to run this AI? This is a person, normal person like me and you. Okay, so we have to learn how the AI works. Okay, but usually the AI is not going to hugely affect the unemployment as people thinks, right? Okay. I hope this I clarify the answers for the AI and unemployment, right? Okay, guys, now let's jump to B, which is the geopolitical factors. Okay, now what are the geopolitical factors? So, geopolitical factors actually it is the tension or the political military things that is happening in the regions between countries. Okay, so we have, for example, the wars and military conflicts, we have political instabilities, we have the sanctions, trade restrictions, revolutions, all of these things, it is considered to be geopolitical, what? Geopolitical factors. Now, geopolitical factors have been the main driving factor for the gold prices in 2025. Okay, so we have seen that we started the year with a war between Gaza and Israel. Okay, this war has been lasting for 1 year, which has led the prices of gold to fly to the moon. This is factor number one. This is just an example. Example number two, when United States of America hit Iran with some attacks for the nuclear weapons they have, this is also an example of war and military conflicts, which has led the prices of the gold also to go higher. And then we have now the attack from the United States of America to the Venezuela president, and they're now controlling Venezuela, okay, in order to take their oil reserves. So because Venezuela, it's the highest country with the oil reserves. So this is also a part of geopolitical tension. And before that, we had the China in United States of America tariff war. Okay, so Trump is gonna impose 100% tariff on China, 200%, and China is going to impose, and so on and so forth. This is a geopolitical tension. Now, if you just analyze the geopolitical factors on the key economic indicators, okay, this is gonna be simple thing, right? So if the GDP is gonna go high with wars and geopolitical tension, it's gonna go down. Okay, unemployment is going to increase, inflation is going to decrease. Simple thing, right? So it's all related to what? It's all related to the economic indicators, right? Now, okay, so now for the corporate financials, I said I'm not gonna speak about this a lot because corporate financials usually, is anyone here interested in stocks, investing in stocks? Yes, okay. How many of you guys are interested in stocks? So investing in stocks, I'm not saying trading in the stocks, okay? Investing in stocks is usually something that is for long-term investing, not for short-term trading, okay? Okay, so what I what I'm saying here, okay, just to invest. Okay, smart people, they make money from trading and they invest long term on stocks. This is a smart move, right? Because in order to feel a profit from the stocks, what you need to have at least 5 years, keep your money in that stock and forget about it. At least 5 years. So how can I know? How can I know that the company stocks is going to go higher, right? This is simply because every company, okay, it has balance sheet, income statement, and cash flow. Every one of these statements, it has a certain purpose. So for example, income statement, it provides us with the profit and losses. If the company is achieving a profit and loss, so let's say profit, net income, okay, in 2024, let's say 50 million, in 2025, 150 million, in 2026, we are expecting that the price is continue, or sorry, the income is going to continue higher. So this is one indication. Now, balance sheet. Balance sheet includes what assets does the company have and what its liabilities, right? The cash flows. The cash flows, actually, there is a difference between the net income and the cash flow. Okay, so the net income, okay, differs from the cash flow because cash flow, it is actually what cash currently, what liquidity does the company have? If the company is having more liquidity, it's something means that the company is doing well in terms of, short-term obligations. However, on the long run, if you have a lot of liquidity, this is something might be bad, right? So in order to understand these income statement, balance sheet, and cash flow, we don't look at the absolute figures. We do something called the ratio analysis. We do something called what? Ratio analysis. And we can do a session in the ratio analysis on how to analyze the company financials, right? Okay. Now, since we spoke about all of these stuffs, okay, about the fundamental part. Now, guys, just let me, or I want you to be honest with me. Did you get the idea of what actually fundamental analysis is for Forex trading? Okay. Why excess of liquidity is a bad, why excess of liquidity is a bad factor in long term. So because if you have a lot of cash that is not utilized or idle, this is going to be a red signal for me. Either you're not able to invest your cash, okay, or you do not have, or you are not using your assets efficiently. And if you're not using your assets efficiently, this is a red signal because if the company is having a lot of cash, okay, and this cash is idle, does not produce returns, this is a red signal because every single cash dollar in the company, we should have a reserve for the short-term obligations if we have something urgent, but we should also invest the excess of cash that we have. Now, if you find that the cash of the company is increasing on a huge percentage from one year to another, and we are not seeing any reflection on the income statement, on the profit and loss, then you must be worried because why, guys, are you having a lot of cash? Maybe you have a lot of cash because you have sold some assets. You maybe sold some properties. You maybe sold some of your lands. So why did you sell them? Did you sell them for reinvesting or buying something better, or you just sold them because you have liquidity issues? This is a very long story. Okay, so we need to understand the full annual report of the company, right? So uninvested cash is bad signal, 100%, 100%, right? Okay. Okay, guys. So I hope you are enjoying this session. Now, the most important thing for us as traders, it is the coming topic, which is the correlation among asset classes. Now, so in finance, in the world of finance, the correlation means what? Co means two. Relation, it's the relation between two things, right? So the correlation, thank you so much. So the correlation, the word co means two. The relation is the relation between two things, right? Now, the correlation is a statistical measure. We use it in statistics, okay? Usually people who are working in the portfolio, fund management, and so on, they understand what do we mean by the word correlation. So the correlation is a number that is having a different values from ranging from -1 to +1. So what does it mean? Now, let me ask you a question. If you are investing your money now, we are not trading, just investing. If you are investing your money and you have invested in two stocks, stock A and stock B, would you prefer your stocks A? If A goes up, would you like B to go up as well? Or would you prefer if the A goes up, B goes down? What do you think? Which one is better? which one is better? -1 correlation or +1 correlation? Up for both. Both goes up. Oh my God, guys, this is very bad answer. I'm really sorry to say that the answer is incorrect. Okay, simply why? Because I'm going to speak about it from the perspective of investment and from perspective of trading. Okay, now if A and B goes up together, that's brilliant, maximum profit. But if B goes down, this means that A is going to follow. Then you have lost all your money. And here you didn't diversify your income. You didn't diversify your investment. The word diversification means that if you have lost in single investment, you should have another investment that cover your losses. This is the simple definition of diversification. Okay, so if you have two stocks and you found out that the correlation is +1, this is a red signal because you have to expect that if the price of any of them goes down, the other will follow. And here you didn't save your losses. Is that clear? Now, if it's -1, now here you have a diversification because if price of B goes down, the price of A is going to go up. If the price of A goes down, price of B is gonna go up. So you're not losing. Okay, you're just covering. One investment is covering the another investment. Now, what about zero? Zero means that if the stock of one single price of one stock is going higher, the other is not following. I don't care if you're going up, you're going down, and so on. So, for example, if you're investing in real estate and you're investing in bonds or whatever, stocks or whatsoever, real estate does not respond to what's happening in the market. I don't care about what's happening in the market. Okay, so real estate does not care. Like they usually are not affected by what's going to happen in the stocks market or the bonds market. I don't care. Okay. Okay. Now, in terms of trading, and this is the part that you care about it a lot. Okay. Why I should understand the correlation very well? Because see, let me explain to you what are the most important correlation that you have to understand. Okay? See, guys, the first correlation that you should have, or you should understand it, if the interest rate of a certain currency goes up, the currency is gonna go up. So if there is an interest rate going up for a certain currency, the currency should go up. And then we should buy. We should take a long position in this currency, right? Good. Number two, if the dollar is going up, okay, there is an inverse relationship between the dollar and the gold. The gold is gonna go down, right? Because remember, it's all about key economic indicators. Now, if the GDP is doing well, if the unemployment is low, if the inflation is high, we are booming, we are in good economic growth. What's going to happen to the dollar? It's going to be powerful or weak, strong dollar or weak dollar. If the economy is doing well, the GDP is high, unemployment is low, inflation is high. What do you think? What do you think what's going to happen to the dollar? Strong dollar, right? Because people trust the economy. So the dollar is going to go up. If the dollar is going to go up, this means that people are feeling certain about how the economy is doing. And if the economy is doing well, I don't need to put my money in an asset that only its job to save the value of this money. Rather than this, I'm going to invest in stocks. Okay, I'm going to invest in Bitcoin. I'm going to invest in something that produce more returns because actually the economy is doing very well. We are flying to the moon. Why should I keep my money in gold that does not produce anything? So guys, remember that gold is not ever an investment tool. Okay, gold is just something that is made for saving the value of the money and speculation. Gold is not for long-term investments. Okay, okay, because it does not produce any returns for you. Okay, that's now gold, CHF, and JPY. Those currencies are known as safe haven currencies. Okay, so they also gonna go down. Okay, it's very important. Now, if you are a smart trader and you found that the dollar is going up, you took a short position on gold. So you sold gold, right? Is it a smart move to sell CHF and JPY? What do you think? So I'm seeing people saying yes, and I'm seeing people saying no. So guys, here, if you took a position, let's assume that you have $1,000, okay? You opened a position in gold of sell, okay? And you open a position of sell for CHF. You know what you have done? You have taken the same position, but you exposed your capital to more risk because both of them are moving on the same way. Both of them are moving the same way. Both of them, they are against the dollar. So if the dollar is going up, okay, the gold is going to go down. And then you decided to sell gold. Okay, that's good. And then you decided to sell CHF. So what if the CHF was like retracing a little bit up, okay? You have lost your money. You exposed your capital to risk that you shouldn't expose yourself to. You didn't diversify your trades. Okay? So if the gold is going to go down, why should I sell CHF and JPY? This is not a smart trade. Okay? Hope you got my idea. Okay? So guys, it's very important. Okay? I see a lot of people, they just open multiple trades. They sell gold, they sell CHF, they sell NZD, and they do not understand that you are taking the same position. It's the same thing. Why you are just open multiple trades, your broker is taking commission from you and you're exposed to spreads and everything, and you are exposing your risk to more your capital to more risk. It's the same trade. Why did you open it twice or three times? It does not make any sense, right? So it's very important to understand this. This is why correlation is a hugely important thing, right? Okay, number three. Now let's discuss about dollar and oil. So if the dollar is going up, sorry, if the dollar is going up, oil should be going down. If the dollar is going up, how do we arrive to perfect balance in exposure between gold and US German indices? Okay, I'm gonna answer your question, okay, because there is no optimal balance. It depends on your risk and your capital. There's a lot of factors I need to understand before answering your question, but I'm gonna give you a general idea about it, okay? So if the dollar is going up, guys, the oil is going to go down. You know why? Because usually when the countries they are trading oil or they are buying barrel of oils from each other, okay, they buy in dollars. Okay, so if the dollar becomes very expensive, this means what? That the oil is going to be very expensive. And if the oil is going to be very expensive, the demand is going to decrease. If the demand decreased, this means that the price of oil is going to drop. Okay, it's all about supply and demand, right? Good. Okay, for the indices, again, what is the relationship between indices and gold? If the indices are going up, Sorry, if the indices are going up. Okay, guys. Now I want you to answer me. What do you think should happen to the gold? I'm curious, do you long Euro USD and GBP USD at the same time, or instead just trade one? I just trade one because if I took Euro USD buy and I took GBP USD buy, I do the same thing. Okay, so I'm exposing myself to a risk for two things. I doubled my risk. Okay, on the same thing. Just take one pair, right? It's gonna go up two, gonna go down. Okay, gonna go up. All right, that's good. So guys, if the indices is going up, now here, the indices reflects what? The indices reflects the stock market. Can you tell me when is the stock market is doing well? When the economy is doing bad or when the economy is doing well? What do you think? When the economy is doing well, of course, Musan, I cannot invest in stocks when the economy is doing bad. You know why? Because if the economy is doing bad, this means that the companies, okay, are struggling. If the companies are struggling, they are not able to bring more investors or more shareholders because at any point of time, this company might collapse, right? So the stocks in the normal case, okay, they grow up, okay, when the economy is growing up. And they are collapsing when the economy is collapsing. You know why? Because stocks are risky assets. And we do not invest in risky assets, okay, unless we trust the economy. If we are not certain about the economy, why should I put my money in stocks? Because I might lose it at any point of time. So that's why people, when they feel risky or uncertain about the economy, they go for the gold, right? So if the indices are doing well, this means that the stocks market is doing well. If the stocks market is doing well, the gold should go down. And this is, guys, in the market, it is known as risk on sentiment. You know what does it mean, risk on? That people are willing to take more risk. Give me more risk. Okay? Because I trust the economy. I can see that we are booming, right? So if we are booming, then let's take more risk. Why should I buy gold? Gold is not going to bring any returns, but stocks are going to, right? Good. Now, the next move or the next correlation, the oil and the Canadian dollar. Now, if the oil is going up, the Canadian dollar should go up. Okay? These are known commodities currencies. The CAD, the AUD, and the NZD. So guys, some people, I see them a lot, they are trading NZD CAD, AUD CAD, okay? But they do not understand the fundamentals behind the drivers of these currencies. How many of you guys have took a trade before on the NZD CAD? New Zealand dollar against the Canadian dollar. Okay, guys, have you traded these pairs before? AUD CAD, AUD, NZD, NZD CAD. Have you taken any trade before? Yeah. What news have you checked? You should understand. Okay, because these currencies are known as commodities currencies, commodities related currencies. The AUD, the NZD, and the CAD. The CAD is linked to the oil. Okay. The gold is linked to the Australian dollar. So as you can see, if you can see here, let me just go to the chart quickly. Okay, so the gold is still ranging. Okay, let me go just here to this is the gold, right? It's an uptrend, clear uptrend, as you can see here. Okay, if we just bring the daily chart, it's gonna going up. Now, let's us check the Australian dollar. Okay, Forex AUD USD. Okay, it also going up. Okay, so they are following each other, right? So AUD is following the gold. If the gold is going up, AUD is going to go up. If the gold is going down, AUD is going to go down. Okay, see again here. So here in this area on October 20th, okay, the gold has started to drop. Let's go for the AUD USD. Okay, on October, okay, as you can see, okay, it was actually also going down, right? So why is this? Because Australian dollar is following the gold. Now, guys, it's very important to understand. It does not mean that if both of them are linked, that if this go 1% up, the other is going to follow by 1% up. No. Okay. So the correlation, just to let you understand, the correlation, okay, it might be, let me just write it here. The correlation, it might be 0.55. What does it mean? It means that if there's one currency goes by 1%, the other currency might follow, but it's going to increase only by 0.55%. Okay, if it's maybe it's going to be negative 0.3. Okay, not necessarily negative 1. Negative 0.3 means what? Means if there is one currency goes down by 1%, the other is going to increase, but by only 0.3%. Okay, so it's not necessarily that if this goes up directly like 0.1% up, the other one is going to be negative 1 exactly. No, this is not happening in the real life. Okay, okay, okay. Now, the last thing is the industrial materials. Okay, which is any industrial material, it follows the AUD and the New Zealand dollar. Okay, if the industrial materials are going up, then the AUD and the New Zealand dollar are going to as well go up. Okay, so guys, why I'm teaching you this? Because it's very important to not expose your capital to trades, assuming that you are taking a different position and you are taking the same position. Okay, so I don't want to see you anymore, buying or shorting gold and shorting CHF. Doesn't make any sense. I don't want you to anymore to buy, for example, let's say here, if the dollar is going up, okay, usually Euro and USD, sorry, Euro and GBP, the major, are going to decrease, right? So I don't want you to take a buy position in Euro USD and then buy position in GBP USD. It's the same trade. It doesn't make any sense. You are just trying to lose your capital faster. It's not a smart move, right? Specify why gold does not produce income in the long term. Okay, so I'm just I done with the session. So let me now answer your questions. Could you please specify why gold does not produce income in the long term? Because see, income. Okay, if we just want to define the word investment, okay, so investment means that I should have either income or I should have a capital gain, right? So what is the income? Income maybe in stocks, we have a sort of dividends. If you are investing in real estates, it may be the rent. If you're investing in bonds, it's going to be coupons. So you're just getting a yearly or semi-annually or monthly income. Capital gains when you buy something at a cheaper price and you sell it at a higher price. Now, gold does only give you a capital gain, but however, remember that if you bought the gold on 2020 for, let's say, $2,000 and you just kept it for 2025, for $4,500. Now, you would think that, okay, I have made $2,500 as a capital gain. But in this period, there is something called inflation. What does it mean, inflation? Inflation that the prices are going to increase. So whatever the $2,500 that you have made, they are going to be eroded by inflation. So as if you have done nothing. Okay, it does not provide you with any returns such as dividends, rent, coupons that has a value at the current time. Okay, it just save your money for a long time, right? And then you might be selling them, okay, and then the price goes down. Okay, gold all the way. What are the coupons? Coupons is just when you deposit your money in a bank, they give you some interest, right? So the companies, sorry, just a minute. I'm really sorry. I'm enjoying the session with you guys because you are uh, asking a lot of good questions. Okay, so just give me 5 minutes more to reply to all your questions and all your doubts. And then if you don't have any question and you would like to drop off, please feel free. So the companies might be issues instead of stocks, something called bond. So this bond is just a piece of paper that promises you to pay you interest. So if you buy this piece of paper, the company is going to pay you 5% for a number of years. These 5%, it's known as coupons. That's it. Okay. What are coupons? Okay. I find here, could you please specify why gold does not produce income in the long term? I think we have answered this. Please also gold and NAS 100 correlated. Also, of course, they are negatively correlated. And guys, one thing that I forgot to mention to you about correlation, you know that the Bitcoin is correlated with NASDAQ. Bitcoin is correlated with NASDAQ. So if NASDAQ is going down, because NASDAQ is the representative of the tech stocks. Tech is the most or the riskiest sector for now. So if Bitcoin is falling, NASDAQ should be falling. If Bitcoin is going up, NASDAQ should be following up. NAS 100, okay, and gold, they should be negatively correlated in the normal conditions. Okay? Any more questions? Any more doubts? What are the best recommended source for news apart from typical Google searches? You just need to go for the economic calendar. That's it. Very simple. Okay. And if you just need to go for MyFX book, for example, MyFX book, economic calendar, you just open it like this. Okay. And then you would go here. Okay. Just do the following that I'm gonna do. One thing, you just need to, like, for example, here, what you need to care about the gold, you need to understand what's happening on the US dollar. So here is the employment change. So employment, it is one key indicators of what? If economics, right? So if the results are negative for employment, this means that the economy is not doing well. And if the economy is not doing well, this is bad for the currency, which is bad for the US dollar, which gives the hike for the gold, right? So as you can see, guys, job openings, and on Friday, we have the non-farm payroll, unemployment rate, all of these things, it is high impact news because it's a key economic indicators. So gold is better than doing nothing with the money or investing under inflation rate. Yes, yes, yes. That's true. Thank you guys so much. I really enjoyed being with you. Hope we can meet again on very soon webinars. Thank you so much. Thank you so much. Have a lovely day. Thank you, Elvin. Thank you. Thank you, guys. Thank you. Thank you so much, guys. Thank you. Really appreciate it. Yeah, yeah, of course you will be able. It will be launched on you will find the recording on the website. Yeah, sure, sure, sure. We can have another session on the technical analysis. Thank you. Thank you, guys. Thank you. Have a lovely, profitable day. Mustafa, thank you so much. Thank you. Thank you, guys. Have a lovely day. Thank you, guys. Thank you.